Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. I am one of your hosts, Ryan Henderson, and I am joined as always by Brett Schaefer. We do this every week live on YouTube at 9:30 a.m. Pacific time, 12:30 Eastern time. And if you want to ask questions, if you want to get into the comment section and ask us anything, you can do that on YouTube just by looking up Chit Chat Stocks. If not, if you're listening to this podcast, then feel free to do that as well. We've got plenty of good topics. We talk all things financial news on this show, and there is plenty to talk about this week. I think maybe the headline here is this the return of the Nifty 50 for all you market historians that remember it was like 50, what was, I can't remember the actual, if it was like the 50 largest stocks, but basically everyone thought they were these unbreakable stocks in the early 70s that kind of traded sideways for 20 years and didn't really work out so well. So we're concerned that maybe we're in that situation again, and Brett's going to give a little piece on that. We've also got some other news. Jamie Dimon is not buying back stock. He made that very clear. Elliott Management, our favorite activists, have wrote a nice little letter to Texas Instruments. And then we've got a bunch of other topics as well. So we will get to those. I guess, Brett, how are you doing this morning? What is your topic you're most looking forward to?
I'm most looking forward to the Nifty 50 conversation. I think that's going to be fun. I think there's two sides of, the people that say buy quality at any price. And I know a lot of them do consider valuation into play there, but at some point, a stock, no matter how good it is, or excuse me, a company, no matter how good it is, the stock, it's too expensive to buy. So I think that discussion will be good. And it doesn't help. It doesn't hurt that I get to write some nice Motley Fool clickbait headlines around this. Costco, Chipotle. Here's some history lesson investors need to know, and hopefully we get some nice clicks there.
Yeah, it's old reliable there. I am kind of curious about the Nifty 50 and whether or not it feels like there are some similarities to today where I think you could call it like the compounder bro bubble. I think is maybe what someone referred to it as, which seems like an apt description because some of these companies, they feel bulletproof, but the valuations have certainly got extreme. Before we
I
get to
agree.
that, though, I want to talk about our friends, public Chit Chat listeners. I'm going to let you in on a little secret. You know how much you hate fees on options trading? You know how these fees can be as high as $1 per contract? Well, public.com has just launched a first of its kind options rebate program that can save you money. In a sleek, modern trading experience, public.com options traders have zero commission fees, zero per contract fees, and trading rebates of up to 18 cents per contract traded, depending on the number of referrals you make. That is right. Public.com will give you back money on every options contract you trade, which can save you hundreds or even thousands of dollars per year as an active options trader. It's simple. Public allows you to spend less and get more back on your options trades. Why would you go anywhere else? Check it out for yourself and start saving on your options trades at public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. US members only. Let's talk Nifty 50. And
Okay.
who would you say is the poster child or the leading stock here of the modern Nifty 50?
It's got to be Costco for me.
Yeah, no doubt. I knew you were going to say that.
I mean, that's the one that people have argued about so much. People have said at 30 times earnings that it's a little expensive, then it gets up to 35, then it gets up to 40, then it gets up to 45, and now we're at 50 times on a price to earnings basis, I believe. And what's interesting is what happens here is that you can have a maybe a logical line of thought where you say, this is going to be a low grower, maybe 10% revenue growth. Margins aren't going to expand that much because of the business model. Yeah, they can raise prices on the membership, but they're not going to do that too much. And you can say, hey, it's not really something I'd want to buy at 35 times earnings. But then you look really dumb as it shoots up to 53 times earnings. So I think when price drives narrative like that, it can be a bit disheartening for someone that's trying to be valuation focused. And this is what happened in the late 60s and early 70s is there were all these articles, all these funds, everything really just people talking about how the Nifty 50 stocks, which were McDonald's, American Express, Walmart, Philip Morris, L'Oreal, some stuff like that, Coca-Cola, which a lot of those that have survived to today did actually fine over a multi-decade period, but that's just because they were so cash generative and returning a lot of cash to shareholders. They did terrible over the next 10 years. But people said, look, these stocks have done so well. It doesn't matter what price you pay for this for these group of stocks. They're gonna beat the market. And I think that line of thinking is showing up a little bit today, but there are still a lot of critics out there, and I think it's just one of the things where you can't let price drive narrative, and you can't say, "Ah, okay, this stock, like, I'm just gonna buy Costco because it's done well, it's a good business, I'm gonna buy it 50 times earnings." You have to think 50 times earnings is a lot different than 35, and 35 is a lot different than 20. That's my, I guess, opening thoughts.
Yeah, it's easy to walk into a Costco and realize, damn, this is one hell of a business model. This is, people love this place. I'm going to be probably coming here for the rest of my life. I'm going to be paying for my family's groceries here for the rest of my life. What a powerful business model. But you also look at Costco and you say, this is everywhere around the country. People already know and love Costco. It's in a lot of ways a mature business. Now, it could probably grow for 5 to 10% on the top line revenue for the foreseeable future, inflation plus some. But if it grew revenue 7% for 10 years, what is that, a double in revenue? It would
Sure.
still be trading at, like, if it grew earnings at 7% for 10 years, it would still be trading at like 25 times earnings. No more, 28 times earnings on 10-year out earnings. Like,
Yeah.
that's wild. It's,
Yeah. Go ahead.
you can't just, I like the idea of being a never sell, close your eyes, put this in your coffee can portfolio and just ignore it. But it's, I don't see how anyone makes money over the next 15 years owning Costco at these prices. I'm sorry. I just don't see it.
Yeah, and I think, I don't know what the time period is, but definitely a 10 bagger over maybe a 10 or 15-year period. If you bought it when the stock was at a reasonable earnings multiple and you've done well here, I see no reason to sell out of your position. I mean, that's usually a dangerous thing where if you're thinking, look, I'm going to not take the taxes, I have no reason to sell this now, I don't need the cash, I'm just going to hold it. No big deal to me. But maybe it's getting to the point when it's above 50 times earnings for a low grower like this where I would trim down the position. And then maybe if it got up to something like 70 to 80 times earnings for a low grower like Costco, that's not obviously like Nvidia where it can grow revenue 200% or something like that, where there's some giant inflection point. That's just not going to happen with Costco. Maybe if it got up to that, like there's different ranges here where he kind of hit to the 35 to 40 times earnings. Maybe you're you bought it, but you would not buy any then. You're not going to sell any of your position. And then it hits maybe 50 to 60 times earnings. And you're like, look, things are getting pretty crazy. I might trim my position. And then at some point, you have to ask yourself, when would I sell out of this entire position? When am I being either dishonest to myself or when am I being too obtuse, I guess? I don't know. Or something where you're not thinking logically because where the stock price is. And I get that people that are in the never sell camp and have bought it at a reasonable price and are just going to hold on, but at some price there has to be a thinking where, look, the next 10 years could get ugly for this thing. Do I love this company? Yes. Is it one of the best businesses in the world with a great management culture? Yes. But things could go poorly, and I'm not gonna be afraid to sit in treasuries instead of this thing right now.
Yeah. No, it's so pull this up on FinChat, the price to earnings multiple since 2014. And the minimum it's traded at, this is actually kind of mind blowing. The lowest price to earnings multiple it's had has been 25 times, which is quite surprising. The average is 34 times, and I would guess that the median is probably around 30 times. I can actually just check it right now. um, 33 times. So you could have said, oh, yeah, you know what? People have been complaining about Costco's valuation the entire last decade, and when it was trading at 30 times earnings. Yeah, well, a lot of the returns have come from it going from 30 times earnings to 54 times earnings.
Right. Big difference.
For you to replicate those returns again this decade, you need it to go from 50 times earnings. Either you need accelerated growth, which becomes harder at this size for Costco, or you need it to go from 54 times earnings to 100 times earnings,
Yeah.
which
So
that's a
that's
harder
why I
bet to
think.
make.
Yeah, and I don't know if there's 50 of these type of stocks out there, but people talk about Chipotle in there. There's a lot of restaurants. You got Cava that just went to the public markets. Wingstop's trading at 100 times earnings as a restaurant, stuff like that. Have some comments here that says, I would buy Costco if they would double the number of gas pumps at the warehouse, just turn them into a Bucky's, I think is how you say it. Sorry, we don't have any of those out here. That's obviously those type of stores have done well. Um, James Goodwin, our actually friend and sponsor, you're missing the potential efficiency improvements from AI, sarcastically. So I think that's a point here that like this is not going to be some sort of optionality type technology company. Um, we have one Sweet Green and Dutch Bros as well. Yeah, Dutch Bros isn't as expensive anymore, but still up there, I would say. But here's a question that Tyler has. Why do you think competitors haven't been able to eat into Costco and Chipotle's consumer value prop? If a competitor started eating the ROICs down, the multiple re-rate would destroy fortunes. Yeah, I mean, it's a good point, but I don't think Costco, I think that mode is very rock solid. I mean, just for the family shopper in the United States, especially, there's no better place for someone that has multiple kids. It's just not going to be beat. But Chipotle, it could happen. I mean, that's a little riskier just because they have to keep up the quality of the restaurant. You've seen those. I think those are just news, not or noise, not news. With those TikTok videos of people getting upset about their Chipotle bowls, which I think is more on the TikTok video maker than the Chipotle itself. But yeah, I mean, if that happens, that's the risk of buying something at a high price. Is you are betting that the perfection of this business, the higher price you pay on an earnings multiple, you're betting the perfection of this business stays around for longer and longer and longer. And then the farther you get into the future, the more unpredictable it is.
Yeah, their returns on invested capital really aren't that insane. Uh, yeah, they're not earning tons. It's not like they're drawing all this attention to themselves with the capital they're earning on their investments. So with the return that they're generating on their investments. So uh, it's really quite a bulletproof model, especially as you continue to reward your customers with lower and lower prices. The more that they come back in, it's really hard to beat their economies of scale. But they just simply can't grow at that high of a rate for that long. It's
Yeah.
really not doable. Um,
Unless they
so
take over. Yeah.
I actually feel bad. I don't feel bad, but if I were management, I wouldn't know what to do here. It's because it's a really difficult spot to be in. And it's actually the opposite. We're going to talk about Jamie Dimon in a second, but it's the opposite of what Jamie Dimon has done. What do you do if you're Costco? All of a sudden sabotage everything you've done historically, where you give like special dividends and reward shareholders and start diluting them in order to, because
Just give
mathematically
the
that's the right thing to do, probably, is to
Yeah, just give out the
issue
special
shares.
dividends.
Well,
Yeah.
I'm saying, like, would you start issuing shares at 50 times earnings?
Oh,
It's not
probably
in
not. I think
management's
that
culture.
yeah, no, that's they can probably just sit on the cash and keep with the conservative balance sheet, and then pay out some special dividends if they need to. Let's hit an example here of a what.
I just
ins-
before we move on,
Okay.
you get in a situation like this. How do you proceed over the next 5 years without losing shareholder money?
Oh, I don't think they're focused on that. I think they're just going to keep running the business. If the stock goes down, so be it. They're not worried about that. I don't think. At least my read into Costco's culture. I guess I'm not in the board meetings, but I don't think they care, and that's a good thing, honestly. But it's like Munger said, RIP. I think this was back when it was at like 30 in the 30s on a PE ratio. He said, "Am I selling it? No. Am I buying it today? No." That's essentially what he said.
Yeah, it's probably just a ton of index ownership, huh?
Probably, yeah. And I think there's some nifty 50 attitude here where it's like buy a good stock at any price. Let me go through. There was a nice little viral, this viral for FinTwit standards on Twitter, a nice little thread that talked about essentially it was a good tease. It said now would be a good time to study the Nifty 50. McDonald's was the OG Chipotle of its day, and it gave out some stats here. So from 1972 to 1980, and 1972 is when the Nifty 50 bubble popped. Revenue at McDonald's grew by 24% a year, and earnings per share grew by 25% a year. So basically in line per year. So that's pretty high growth, really, really strong. And the thing is, from 1980, the stock was down 35%. Adjusted for inflation, it was down 67%. But the business was incredible. So I think multiple contraction is a big risk that doesn't the fact that you're making so much money in multiple expansion can blind you from the fact that multiple contraction is so dangerous over a 5 to 10 year period because you can't if you kind of get what I mean here, where you're not realizing the risk you're taking on because the all your returns are coming from multiple expansion and you just price drives the narrative. I think that's just a big thing.
On the flip side, there was that McDonald's example. What a great buying opportunity that would have been at the
In
end.
1980.
Yeah,
Oh yeah.
after it traded sideways and everyone became fatigued after 15 years of going nowhere.
I, everyone would hate it too. Everyone would hate it. This thing has gone nowhere.
Yeah,
Oh, why would I buy it? It's gone nowhere for 10 years.
I'm looking at
Exactly. But
something right now for Costco that might blow your mind. Since September of 2017, which I
okay.
think is when they wrap up their fiscal year, the September fiscal year. Um, their total revenue has grown at 10.7% a year. Pretty solid. Their price to earnings multiple has grown at 11% a year. Their valuation has grown at a faster rate than their business.
Yeah, so you're seeing more returns as shareholders, excluding dividends, from their multiple expansion than the actual revenue growth, assuming earnings grew at the same rate. I'm not exactly sure. I have a comment here with the high PE business. Isn't it what Singleton did at Teledyne? Whenever his stock was overvalued, he would buy low PE companies with his high PE businesses. Yeah, they can do that, but that's riskier. And the only way that works is if you're set up with a culture of being a conglomerate already. Someone like Berkshire, Nelnet, uh, Constellation Software, Markel, Brookfield Asset Management. That's the advantage of those. But Costco's not going to go, hey, let's buy some low PE industrial business. They're not doing that.
No, maybe they could buy like a logistics business, but they already have one that they've built out. So I don't see there's no unless there is like a situation and it's a way to just get there quicker. And maybe it's a business that earns money already on its own. You could, but then like you're buying Costco, the capital allocators, or are you buying
Right.
Costco, the grocer or the
Yeah,
wholesale company?
exactly. Now, I know there is the classic argument that's got tossed around that says, well, if you held on through like 1995, didn't the Nifty 50 actually outperform? I would say one, underperformance for 20 is a mistake in buying a stock. And I would say two, it was basically all driven by tobacco. So
Yeah, if you
either include that or
exclude
exclude that.
tobacco, you're
Exclude
those
tobacco,
returns.
and I think if you exclude tobacco and Coca-Cola, you underperform. So a lot of them ended up being mistakes.
Yeah, you can thank Philip Morris. And it's crazy that Philip Morris, at the peak of the Nifty 50, the valuation was still not very insane. Like, I think
And
they generated what was it, like 18% annual returns from the peak of Nifty 50 multiples.
yep, and I think the implied price you should have paid, given where like if it was going to trade at a market multiple um, in the 90s and get the equivalent to the S&P 500 returns over the time was something like 40 times earnings. So that was a good run for the old tobacco businesses. Okay, let's
We've
hit a
got some
new
questions
topic.
here. We've got some
Yeah,
questions
yeah.
we should address. Okay. So John Gallagher says, "Good morning and happy Thursday, Chit Chat crew. Thanks for the portfolio video. I am long British American Tobacco, Altria, and Turning Point brands. Any thoughts on Pfizer? Is it a value trap or possible double with the sweet dividend?" So I guess for anyone that missed it, we did it. Brett and I did an overview of both of our portfolios, what we like best, what we're potentially buying or selling. And we discussed Philip Morris in depth kind of during that show. So that's where I think John's mentioning the tobacco companies there. On Pfizer, I hate to let you down, John, but I am the least qualified person to give any sort of take on Pfizer. It's just a business I've really never looked at.
Same. What would this be? Pharmaceuticals? Not my cup of tea. You're gonna have to listen to another podcast on that. We have some questions on Twitter as well. We have one on the Texas Instrument News from Elliot, which I think is going to be a good topic. We can say that kind of as the non. Well, I guess it's still a fun topic, but it's not a sexy topic because we'll have to just kind of go through some capital allocation stuff. We have a question on day. Maybe we could save this for the FinChat ad. Day 282 of requesting a ticker KFS. I think it's a small financial company. I'm sorry, we're not going to do a full topic on that because it's just not popular enough for people on a podcast to listen to. We have a question on.
Let's do a quick glance at it. How about that?
Yeah, do it. I said I was gonna do it for the advertisement right now.
Okay. And then there was a question on Jamie Dimon, so we can touch on that as well. This is kind of our embedded FinChat ad, and it was what, KFS?
KFS is the ticker. I believe it's from Deep Moat Society. So yeah, he's been very persistent. Whenever I tweet, what should we talk about? He says it every time for the last couple of months, and then I go, well, it's just not big enough for us to talk about it on a live show. But he's been persistent, so let's talk about it.
This is our audience, Brett. We have to please the listeners. Pulling it up.
What are you noticing first?
Kingsway Financial Services. Okay. Market cap of $223 million. Enterprise value. Company description here. Kingsway engages in the extended warranty business services, asset management, and real estate businesses. Company operates through 3 segments: leased real estate, Kingsway Accelerator. So warranties, not an industry I'm intimately familiar with. Asset management, probably pretty digestible, understandable. Real estate, definitely wouldn't consider myself an expert there, but fairly understandable, I think. If we look at the only problem with these asset managers, it's like total revenue is not always a great indicator, so it's a little hard to analyze purely on just a research
maybe
terminal.
look at
book value
maybe
per
pull
share.
the price to book. Yeah.
Okay, let's go to
And book
ratios
value
here.
per share growth.
Per share, book value per share. Well, maybe something happened in the early or 2014 through 2016. It looks like it's struggled a little bit. Let me look at the total return
Or maybe they
over
sold
the last 10
something.
years. Maybe there must have been something that happened between 2015 and 2018. If you look at the 5-year total return, 27% annually, pretty good. Something has been happening over the last couple of years. I'm not going to be able to analyze it, I don't think, on this.
What's the price to book and what's the price to earnings?
One second. Price to book. It's a little complicated because it looks like book value is
Wonky.
Yeah, this ain't working.
Well, isn't the number right there? I can't read it.
It's 9.3 is what it says.
Oh, okay. Well,
so that's why I'm saying it's not. Something's off.
Okay, what about price to earnings?
Price to earnings also off somehow.
Well, okay. Well, then it's gonna be hard to, to analyze on the show. I don't know what the pitch is on this thing. I'm seeing a comment that they are a funder of search funds. I don't like that business if it's a fund of funds business, but does it pay a dividend? I don't know. Any sort of indicator from the
We're gonna
aggregator there.
yeah, we're gonna need a bit of an maybe a more we're gonna need an elevator pitch from what was it?
Yeah.
Deep Moat Society. I love that name by the way. That's
Yeah.
actually quite good.
Exactly. Exactly.
I
Well,
don't I'm not seeing a dividend yield here, so no.
so nothing. Yeah, I would need an indicator of what exactly we're buying and why we're going to buy it. If they're financials, that's because this is just what would be any investor's first look, especially at a financials business. You look at the book value, right? If they're an investment company or a bank style business, I would look at the earnings ratio. I look at the dividend yield. I look at the earnings growth. I look at the revenue growth. All that stuff, just the basics, and say, okay, why is it like this? Why did like Ryan just asked? He saw the revenue go down. I think it was 2016 and he's just, okay, I got to make a note on that. Why did that happen? Let's investigate.
Yeah, the
Um,
other thing, look, this is where the opportunity presents itself. If it's a company that you follow intimately well and you understand what the drivers are of these numbers, because obviously this didn't screen particularly well. Like there wasn't anything that like jumped out to me purely on the financial side of things.
right.
We have companies that we own that are like this as well. Like Nelnet doesn't screen cheap. Harbor Diversified, if you just looked at the financials of that business, you would think it's like the worst business of all time. Maybe it is. The but you know the story better. You understand what's really going on, what's driving it. So on a company like this, where I'm not really getting the picture by looking at the numbers, I would probably try to find some sort of a research write up somewhere on the internet to try to get a quick summary.
Yeah, exactly. Yeah, check out Value Investors Club, all the other good stuff. See if I can find something to see what exactly are people excited about. And if you want to look at those charts and how we how we look at quickly, the fundamentals of the business, doing our quick overview, go to finchat.io/chitchat, get 15% off your premium plan. Link will be in the show notes. DM us for any questions. And Ryan, as a good employee of FinChat, is out there for any demos for anyone looking uh, to. That's basically his job. So
Anyone looking to fill up my calendar? The
exactly, exactly. Here's a question on buybacks, and he had a topic on it too from one of the one of our followers on X/Twitter. So I can lead into maybe your topic on that because I know you had it. When someone like Jamie Dimon says he's not buying back JP Morgan stock because capital deployed more efficiently elsewhere, does that mean that investors shouldn't be buying? Anecdotally feels that bank buybacks have declined, Ally, Bank of America, etc. Only American Express has maintained its pace of buybacks. Ryan, thoughts on that and maybe lead into that Jamie Dimon quote that was floating around the financial news this week.
Yeah, I don't have the exact quote. I can probably find it, but more or less, he basically said like, "We're not buying back our own shares at this price. We don't think that's the place to do it." They have been good share repurchases, ironically, um, but he said, "We're not buying back. I think it's dumb to do that at 2 times book value." The stock sold off roughly 4% on those comments. It might have jumped back up since then, but what would I do if the CEO said that? I probably wouldn't feel super eager to buy, but that doesn't mean like Buffett's done this along the way too. He's kind of I think in especially around 2000, right? He basically said like, look, our shares are a little overvalued right now and you can try to talk. I think that's what a good manager does is try to talk it down. I wouldn't sell my shares because of this. Because this can still generate decent returns, especially over like a long if you really extend your time horizon, then I think you can still get market beating returns. But I wouldn't necessarily sell my shares. I probably wouldn't feel that eager to buy back if the management team has no interest in it either, or buy more. With regards to the overall banking share repurchases, yes, I believe there was a mandate or some sort of regulatory thing that required a whole bunch of banks to up their capital ratios and be a little more well reserved. So a lot of banks have stopped buying back for that reason. So they've had to get over a certain uh, liquidity ratio, essentially. I can't remember what the ratio was or what the specific number was, but yeah, a whole bunch of banks had to like slow down their buyback pace.
Yeah, and there's two other things. Interest rate hikes have caused the balance sheets to teeter a little bit, and they have been generally skittish ever since the Silicon Valley Bank and First Republic and what was the other one? Signature Bank collapsed. Actually, a little over a year ago from now. Ryan, do you remember that the banking crisis that was going to take down the global economy again? It's
It's
always
funny to look
nice to,
back on
yeah,
because it was really just one bank that had way too much of a customer concentration on deposits and
or
bad
three,
loans.
but three not giant ones.
The Silicon Valley raised the awareness for it. The Silicon Valley, you look back on that, like what a risky kind of dereliction of duty for the people running that company. You have a whole
Oh,
bunch of VCs who are more of a herd mentality type group than anyone else, and they are your biggest depositor base. If one floods, a whole bunch are going to flood. They can really dictate whether companies pull out their funds or not. And then I believe they shortened the duration on their assets. So they owned a whole bunch of pretty low interest rate assets. So yeah, they were super underwater on like everything.
yeah. I mean, I think extended the duration.
Oh, sorry.
Yeah. They bought a bunch of 10-year treasuries, I think, and mortgages at super low rates, right? And they locked
Yeah, it
in.
was.
Yeah. Something like
Can't
that.
remember the situation exactly, but it was like they were they were earning like 3% a year.
Oh yeah. Charles
And
Schwab is
so
still in that yeah, Charles Schwab is still in that same um they're facing that same headwind right now, and they'll hopefully be able to get through it. But there was a lot of people talking at the time that they were the next domino to fall, and luckily it didn't happen. I don't think it would, just because they're too systemically important.
and
Yeah.
okay,
Okay.
that's right. Yeah, they extended the duration on their loan portfolio. You look at a company who did not, Interactive Brokers, they were buying like what was it, 3-month treasuries consistently, just
Right.
rolling them, and they were earning nothing on it for a while. Then all of a sudden everything flipped and their interest income ballooned. They were better off for it.
Giving them flexibility as a financial. Okay. Other question. Let's say, did we already have the CRM discussion? No, we did not. I don't follow the company close enough, but maybe the most. I know the stock went down. I don't even know anything about the earnings. Um, I don't know if I included this in here, but there was a quote that essentially said from Mark Benioff, I think on the earnings call, that said, "There's no one better at M&A than Salesforce." Let me try to pull up the direct quote,
Yeah. It's on
because I know
FinChat if you want to look
someone
at
I
it.
follow has it.
It's also, yeah, if you go to, I posted it on the FinChat Twitter account. Before we get to that, I do want to talk about our friend, the Firm Returns stock research blog. This is not really a new sponsor anymore, but now kind of recurring sponsor, Firm Returns. They are a stock research blog that covers stocks from all over, really emphasizes the UK, which anecdotally, I've been seeing more and more UK companies pop up on screeners I've been doing and just general. I don't know. I become generally more interested in the UK market, and he really invests across the spectrum from $10 million companies all the way up to $40 billion. He tries to talk to management whenever he can and get access to them, which is easier to do when it's smaller caps from the UK. He gives you 4 in-depth research reports on new companies each year if you're on the paid tier. And then he has a whole bunch of free content and other long form write-ups on Firm Returns as well. So highly recommend going, checking it out, at least see some of his free research and then determine for yourself whether or not you want to be a paid member. And if you do want to be a paid member, firmreturns.com/chitchat gets you 20% off. So go ahead, check it out. Firmreturns.com/chitchat. Also, before we move on, you heard us earlier in the show, you heard us talk about the investing platform, public.com. That is where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. US members only.
Okay, I
So
have the
Mark
quote.
Benioff, yeah, give the
I got
quote.
it. Quote, no company has been more successful on M&A than Salesforce. Ryan, you have the floor.
Google acquired, what was it, DoubleClick? That's like probably the most valuable acquisition of all time. YouTube acquired YouTube, very successful.
Android.
Android. Meta acquired Instagram, acquired WhatsApp. I'd argue WhatsApp is probably more valuable, even though it might not be monetized quite as much as some of the Salesforce acquisitions. More valuable. Amazon, have
Constellation
they done
Software.
any huge high profile acquisition? Berkshire Hathaway,
Yeah, honestly
ever
though,
heard of them?
yeah, but honestly, their Foley acquisition stuff is really not that great. They've done a lot of big stuff that generates profits, but the return on the best stuff they've done, yeah, I mean, See's Candy, but that was back in the day when they were way smaller. But the best, most returns have come from that stock portfolio and the insurance operation. I guess Geico
Insurance
would
is
be considered
acquisitions, though.
somewhat. They bought a tiny insurer and then built it up almost themselves. But Geico, Geico is in there and way better than anything Salesforce has ever done.
Isn't general reinsurance like a huge part of their business now?
Yeah, but I would say remember that was a bad acquisition. Oh, actually, never
For a
mind.
while.
That was good timing because they used the stock at when it was super inflated. So good timing on that acquisition. I guess the financial engineering Buffett did was probably smart, but remember they found a bunch of cobwebs in that asset.
Yeah. There's a million better acquirers. I'm sorry. Salesforce, look,
Transtime.
yeah, maybe not a million better acquirers, but I think Mark Benioff is kidding himself if he thinks he's absolutely hit the nail on the head here. Slack was, and also, okay, if you make a bunch of good small acquisitions and scale them up, and then you blow that up with a big bad acquisition, you ruin your returns. Like, Slack is probably not doing too hot for them.
No,
And
yeah.
that blows up a lot of their previous great acquisitions. It's like Bob Iger, right? You buy Marvel, you build all this asset value with by Pixar, great acquisitions. You become a great acquirer, and then you piss it away with the Fox acquisition. I'm sorry, it's a stain on the reputation. Now, who really knows what Slack is worth today privately? But what did they pay? What was it, like $25 billion for that or something like that?
Yeah, I'm not exactly sure, but it was a sizable number. It was a very extreme valuation at the time. And then they got ladder attacked by Microsoft Teams. And I don't okay.
I think they'd be in the
Let
same spot as Zoom, Slack would.
Yeah, exactly. Now, obviously CRM stock, Salesforce stock over the long term has been a phenomenal winner. The durable revenue growth has been incredible. If you are an investor today, let's say it's been a 10 bagger for you, a long-term winner, you hear Mark Benioff say, we're getting back into M&A. We are he has this irrational confidence of how good they are at acquiring companies because it doesn't seem like he understands how they make money, um, how return on invested capital works. Wouldn't that be a huge concern for you? I mean, that's a sell signal for me. And I think today a sell signal for a lot of people. Stock's down
Mark
20%.
Mark Benioff is a walking sell signal.
Yeah.
Everything he does, I swear he has a god complex about him. Like paying Matthew McConaughey $10 million to be your friend. Look, that's a huge red flag. It means he cares more. Like he is wasting company money.
I got one person, some commenter, Investing for Beginners podcast, which are friends. Thank you for joining, guys. Has a comment that I think there's one clear acquire that is worse, and that is the
Block.
monk himself, Jack
Block.
Dorsey.
Yeah.
Afterpay. That's got to be worse than any of the ones that Benioff has done. I mean, that was just terrible. I guess it was a stock, but Tidal. Now they're still investing in Tidal. They're like the sound quality is better at Tidal, and I'm like, great, you're losing $100 million a year for us as shareholders.
Okay. So yeah, not a fan of Jack Dorsey. Like I don't like him. And he also is a walking sell signal. You know what? Maybe if he were like my friend, he'd be fun to hang out with. He sounds like he like is kind of a crazy guy. Like maybe he'd be pretty entertaining. But
Yeah, same with Musk,
as my
honestly.
fiduciary, someone managing shareholder capital, yeah, I have no interest in that. I'm sorry. The same with Benioff. Now, Afterpay probably worse than Slack for sure. It's the biggest red flag for me is when it's like the little trivial things where where they're using company money to benefit themselves to make their own lives better. So Jack Dorsey trying to become friends with Jay-Z through the acquisition of Tidal. Mark Benioff putting Matthew McConaughey on some role to paying him $10 million a year to be his friend. Look, he views the company as a piggy bank. That's what I think. And I think Mark Benioff has to be careful because he does not have a ton of insider ownership. And Elliott could easily get rid of him if they choose to.
Yeah, they're a little bit sizable. I guess we'll lead into another company that might be a bit more cordial
How
on the
about the
activist front.
Semler Scientific making half its balance sheet Bitcoin?
I was gonna say, my question for you, Ryan, I know you saw this, was, are you feeling it now? Kind of like are you the popular SpongeBob thing? Are you feeling it now, Mr. Krabs? Are you feeling the bubble now? Semler Scientific. Let me pull up the quote. Semler Scientific, a pioneer in developing and marketing technology products for healthcare providers to combat chronic diseases, announced today that its board of directors has adopted Bitcoin as its primary treasury reserve asset. In addition, Semler Scientific announced that it has purchased 581 Bitcoins for an aggregate amount of $40 million, inclusive of fees and expenses. Stock soared. It was a struggling microcap. Stock soared, and I had some people commenting saying that this was an auto sell decision. What's interesting is we had followed Semler Scientific loosely, I guess, over the last 5 years. It's something that's been on my radar. It seemed like an interesting company, but this is the difficulty of microcap land. I mean, it is just a field of landmines of management teams that want to just pump their stock and do things that are actually not rational for and aligned with shareholders. But doesn't this I have another here, let me just relate it to this other topic too. The bubble seems, and don't worry, we'll get to Texas Instruments at the end here. The bubble seems like it might be forming. Now, CoreWeave. Have you heard of this company, Ryan? Okay, he's shaking his head for the listeners.
Sorry, no, I have
CoreWeave is
not.
essentially a new. They're trying to be a competitor with the hyperscalers, so AWS, Microsoft Azure, and Google Cloud, plus others, Oracle, IBM, whoever. As they essentially just raised a bunch of money, bought a bunch of GPUs. I think they used to be a crypto company, honestly, and they essentially got a bunch of NVIDIA chips and are trying to be an AI, cloud provider. And there was I think it was sourced. I forget who it looks pretty reputable, but who knows? Obviously, it's just rumors at this point that it is planning an initial public offering. The startup has started early preparations to go public by the first half of next year, said a person with direct knowledge of the company's plans. The planned setup would be the largest AI-focused initial public offering after the recent wave of funding for private firms in the sector. The move towards a listing also a rare sign of life in the U.S. tech IPO market. So what this Portsea Capital called on Twitter, a GPU rental company founded in 2017, last valued at $19 billion and raised $10 billion in equity and debt to date, looking to IPO in the first half of 2025. This feels to me like Rivian from 2021. What do you think?
I don't really remember the Rivian IPO that well.
$100 billion market cap, Ryan.
Yeah, that was outrageous. And you know what? At least Rivian has materialized into something. Remember Nikola?
Yeah.
That hit I think that almost hit a $50 billion market cap, if I remember correctly.
That's
And there
more like
weren't any vehicles ever.
true.
any working vehicles. Rivian at least has I see them all the time. I don't know if that I don't know what kind of
No,
an
they're burning a
indicator
lot
that
of
is,
cash
but
flow, Ryan. I think they're burning like 6 billion in cash flow a year right now because they're trying to ramp up manufacturing and sales have slowed and they're really hitting the EV capital cycle, which is tough.
yeah, this listen, I'm all for the IPO market being back up because it actually did it kind of sucked when it was happening. Like I was like, oh, these just bad company after bad company going public and all that. But now you do have a lot it feels like you kind of have a lot more to choose from. I think it kind of helps public investors now be able to look at a whole bunch of options as opposed to just either dead micro caps or I don't know. It feels like it just created more options for investors.
Yeah, we have a comment here. Yeah, they started as a crypto miner 7 years ago, decided to turn into a hyperscaler instead.
It's my
It's
favorite
lucrative
signal.
so far because Nvidia can give them the GPUs, but
I love
that's
when
can't be a business
companies
model.
switch to whatever's popular. No shame.
Yeah, exactly. Exactly. Uh yeah, other questions. Okay. You want to talk Texas Instruments and Elliott? I think this one's interesting.
Sure. Yeah, let's do it.
All right.
Activist letter.
So they sent the letter. It wasn't it was mini activist. They said we have a lot of respect for Texas Instruments. I guess, the stock's done well over the long term, but essentially, and it was like a 10-page letter, so I'm not going to read out everything right here. Essentially, they said, and I'll quote this: "We have tremendous respect for TI and its long history as an industry leader and innovator, and we greatly appreciate the board's consideration of our thoughts. We believe our recommended path forward embraces TI's long-term recipe for success and reestablishes its long-term held commitment to its shareholders." Essentially, they're saying, here's our idea. You should go for it. Now, what is the idea? They're saying that TI has greatly increased their CapEx spending and their CapEx spending plans, and they say that they're being too rigid about it, and they're going to just essentially overbuild, or there's a big risk they're going to overbuild their capacity over the next few years, and they want them to temper down their spending and make it more flexible with the demand of the end markets for semiconductors and automotive and the industrial space. Now, if you look at some of the charts, you can see that free cash flow has depleted a ton and capital expenditures have absolutely boomed. Now, one could argue that they're being smart during the down cycle of the automotive and industrial space, where there's going to be long term just a huge boom of electrification and digitalization across electric vehicles, electric vehicle charging, and all the industrial manufacturing, especially with the hopefully onshoring boom in North America and South America. So you have that thesis, but if you look at the free cash flow, it's been pretty ugly, and things could get pretty bad for Texas Instruments if they overbuild by, say, 50%, like Elliott is proposing here. And if you look at the long-term success for Texas Instruments has been very smart capital allocation, staying in their niche, high returns on invested capital, producing shares outstanding, increasing that dividend per share. I mean, it's just been a simple, easy formula. And I think they've gotten away from that. I mean, shares outstanding haven't declined. I wonder what this management team is thinking where we're just going to boom CapEx like this. It seems a bit aggressive. I kind of agree with Elliott here, but curious your thoughts, Ryan.
Yeah, it's kind of a bummer just because I remember we were kind of pitched this stock. I don't know if I'd say pitched, but there were a couple people that mentioned Texas Instruments as a potential investment. John Rotanti came on. I think we did a whole show on them. We talked with Andrew and Dave from Investing for Beginners, and they mentioned how much they like Texas Instruments as well. And the thesis was pretty simple. It was like these were semiconductors that were they have an inventory of semiconductors and a catalog of semiconductors that are always going to be relevant. They're a share cannibal. And now all of a sudden it's kind of a different thesis, right? They're spending so much. It's not just a capital returns durable capital
You
return
g-
story. It's certainly
you gotta hope that the
switched.
demand shows up. Yeah.
Yeah, makes it tougher for me as someone who has zero sense of whether or not where we're at in sort of a semiconductor cycle. It makes it harder for me to invest.
Yeah, and they gave some interesting anecdotes or past stories for Texas Instruments from the Elliott letter, and they said stuff about how historically they were much more flexible in their capital allocation plans. So if they saw the demand, they would build it and stuff like that. And that's all they're saying they should do here. So they essentially were saying, look, if y- if the demand shows up, we want you to spend all this money on capital expenditures like you're planning here, and do it because the return should be solid. You have your competitive advantages, and that'll be great. You'll get, huge investment and a strong return on invested capital. But if it doesn't show up, we need to temper our expectations and pull back a little bit so we don't just blow up and have a huge inventory build, which would be quite concerning. If they, I think they were saying something like 50% over capacity or something like that, which I think that's on the new builds, but still that would lead to a huge inventory glut, which would obviously no one wants.
Yeah. I'm a big fan of Elliott in general. I think when they enter a position, for me, it actually kind of means something. I think there are a lot of investments out there or investors out there where whatever they start buying something and I kind of just shrug my shoulders. But I think Elliott, for one, CEOs, they tend to shape up a bit after they see it, after they maybe get a call from someone at
What
the
about
company.
well, they're in Match Group though, Ryan?
Give it time. Give it time.
Yeah, but what's
So
he
here's
talking
my
about
thing.
on
Okay, if with Match Group, because there is a question about it in our comment section here that says we need Elliott on Amazon, Meta, Match. I would argue you don't really need it on Meta or Amazon, and I don't think Elliott being a shareholder would really benefit the company in any way. Like it, I think they're
they're
doing
too
fine with
big
capital
too.
allocation too.
What if they got them to cancel Alexa in the metaverse?
It just doesn't matter.
That definitely matters.
They're not
That's $10 billion
capable of
in
doing
earnings a
it.
year. What?
They are not capable of that.
I know, exactly, exactly. It's a hypothetical if they could, but yeah, it's not possible. They're too small.
I'm okay. You know what? I'll say it. I don't mind the Alexa spending.
Really, Ryan? It's been 10 years, $100 billion in spending.
I know. I know.
It's useless. They're
Give it
so
time.
far behind everyone.
You know what? They are probably in more households than anyone, though. But so on the
Who
half
cares?
chance,
Who cares? No one uses it. Sorry. We'll talk about that a different day. But
it's I use it every day.
okay, well, they make no money on you.
True. They are yet to make $1 on me. But if they ever find a way to do it, they've got the infrastructure now, the network of households to do it. Anyway, with Match Group, if we see that Elliott has just silently exited its position, I'm probably, well, I already sold my Match Group shares, but I would feel more inclined to not get back in.
Yeah, exactly. Exactly. And yeah, for people asking, yeah, we did during that portfolio ranking show. I did rank Match Group pretty low. So it's it's lower than some stuff that was on my watch list, so there will be some portfolio shuffling. I don't know. Listen to that. I know I've been talking about Match Group for a long time. Still think it's a good risk reward, but I guess the details on that can be for another episode. Yeah, we have Tyler here as a comment. If Alexa has losses of $10 billion and a 30x multiple, well, I don't know about that. That would be a $300 billion swing in valuation. I would think they could just pour it into other stuff, or return it to shareholders. Yeah, I mean, it makes sense. We have a joke here from James that says they're waiting for you guys to leave Match Group first. Gave a little wink. I know he's joking there. Hey, I
We
will
have,
sacrifice
I
myself.
have.
I will sacrifice myself as the bag holder that sells just so Match Group can start soaring. I will make the sacrifice. I plan on doing that actually. Yeah.
It's, yeah, I've already sold. I have already
You
sold.
sold a while ago, like a multiple, not even recently, right? A while ago.
No, I sold after Alex's write up.
Oh, okay.
He
But it was a
convinced me.
small position for you at that point, right?
Yeah, it was tiny.
Okay.
And to be honest, I played it completely wrong. Elliott announced their stake, and I bought. So
At
I
like 30
bought
spot. Yeah, yeah.
when the stock jumped, and then they reported this disgusting quarter, and I sold. And you know what? This is one
Yeah.
where the stock didn't even drop that much after the earnings, but I thought the earnings were pretty rough.
Right. Yeah, and I've had concerns with management. We talked about that before. We might do a full one on them as maybe a post-mortem later this year, maybe sometime in 2025, but it's an example of I can see it in the comments section here too. When you sell something that's down and you admit it's a loser, you the worst thing you want in your mind is for the stock to go up like 100%. And you have to just tell yourself it doesn't matter. It might go up, it might go down. Who knows? You're not in it anymore. You got to just focus on your portfolio there and just keep it on the watch list if you still think it's a good company. Okay, Ryan, any other topics? Someone wanted us to talk Chewy.
Yeah, I think Chewy just
Uh,
had like a marginally more profitable quarter and the stock jumped 30%. So it's
beautiful.
no, I mean, you get like an e-commerce company like that when the margins are so thin, if they can find a way to expand them, you're going to get significant appreciation. I think they did that this quarter. Operating margins, the gap operating margins significantly improved year over year and probably sequentially. So, yeah, I think if you're a Chewy shareholder, it's maybe not what management thought it was going to be for a while. Their active subscribers have, or their active customers have certainly come down, but their net spend per active customer has continued to trend upward. There are people that spend a ton on their pets, and I think Chewy is actually capturing that audience quite well. A lot of them are auto ship customers now too. I think the number's at 77% of customers are auto ship, which makes it logistically a lot easier to ship profitably. Um, and it seems like that's what we're seeing play out here. They've become more and more profitable, and it seems like it's largely from logistics improvements. So, uh, yeah, I'd say kudos if you've been a shareholder, but I don't think the stock's done very well. So maybe if you thought they were going to get to profitability and you bought at the right time, then kudos.
Yeah, it could be a good one to look at. It's interesting,
I don't
but I still don't like their moat. Um,
No, I
let's
don't
see.
know
We had
that.
a question. I guess it's from you. It's in your section. Maybe you want to hit that last one to close things out.
What's the favorite investing books?
Yeah.
Yeah, sure. I got a message this week that just said, will you talk about some of your favorite investing books? I don't have any off the top of my mind. I would say for the beginner, I'll look up some books here in a second. And Brett, maybe you can do that while I'm talking. The For the beginner, there's going to be a lot of investing books that are kind of around how to value a business, how to look at uh, what matters in investing, returns on invested capital, why it matters, what drives returns over the long run. There are a lot of books like that. And I do think it's worth reading a number of those. But once you start to feel like this isn't new information to me, then I personally recommend reading a lot of 10Ks, reading uh, business biographies, like stories of how businesses grew. Um, if you can find like founding stories, I really like those. And just the more 10Ks you can read, the more you're going to be able to apply it to other companies. And it really gives you a foundation for being a generalist. Just the more 10Ks you can kind of digest. So I do think it's important just to get used to or assimilated with the nomenclature, like understand the terminology. But I think there are diminishing returns once you're on your 10th book where you're understanding a lot of the same metrics already.
Yeah. Here's what. Okay. I would recommend not reading The Intelligent Investor. I would recommend not reading Security Analysis. I would recommend not reading A Random Walk Down Wall Street. Random Walk Down Wall Street could have been a blog post, honestly. I would recommend maybe the Peter Lynch book. That's good for a starter investor, especially because you're not looking to get into this just to buy index funds. I would recommend. Um, I read this one recently, so it's a top of mind. Capital Returns, I think, it's like investing through the capital cycle. Sorry, I can't have the exact stuff in front of me. I'd recommend The Outsiders, although that is it. Some people say it's nitpicky, right? Where it's almost survivorship bias, but I think there are good examples there in that book. But yeah, as Ryan said, make sure you learn the basic accounting and then read a lot of blog posts about industry analysis, business biographies. I mean, there's 2 on Amazon that I think are quite interesting to show how like that culture, works. There's the Netflix one that I think is quite good. There is, and I'm trying to just go through the list. I'm reading one on Oracle right now, which is interesting. Larry Ellison is a unique individual, but sharp and just I don't know. He did quite well. There's the Walmart one. There are, I mean, we just recorded a show with Leandro from Best Anchor Stocks, and he did one on John Deere. There's a business biography on that. There's a business biography on tons of stuff out there. So I just read a couple of those at least, or just consistently try to read some of those. I think those can be very, very helpful for how a business turns into a success. Get on Value Investors Club, start reading those type of things, start reading a bunch of Substacks. That can help because you see how people analyze things, what they're looking for, how they determine what the value of something is. And yeah, that's really it. Don't get bogged down and saying I need to read mine next. I need to read another book called How to Invest. Like, you don't need to read those books. They're actually not very helpful, in my opinion.
Yeah, let me just give a couple that I've liked. And Brett, you might have gripes with this one, but I enjoyed Snowball, and you kind of get a sense of how he looks at a business, what he did, what his process was like. And it's a Buffett biography. Um, I liked the book Quality Investing. It goes through some of the competitive advantages that really drive returns over the long run. That's by Lawrence Cunningham. And then there was one more. The Phil Fisher one, the what's it called? One Up on Wall Street is quite good as well. So I'll give those 3 out, or I'll
Also, there's the
recommend those
Buffett
3.
letters, which you can get for free on their website, but I would recommend not reading that until you've got a little bit of experience. Read them, or because it's just gonna be too boring for you if you don't understand all the topics. So save those, maybe couple of years in, I'll turn into such strong performance over the long term. Then we have a comment here, Malbosen's writings. Those you can find those for free as well. It's Michael Malbosen. I think I'm pronouncing it right. Those are, I think, from Morgan Stanley, and he's on Twitter, so just search for that type of stuff. He posted those for free, and they're quite good as well. But like the Buffett letters, you need a little bit of experience first. So you gotta look at the basic accounting stuff and read a lot of blog posts, annual reports before getting into that, because those can be overwhelming if you don't know a lot of the basic terms. All right, we're at an hour mark here, Ryan. I think we close things off. Anything you want to say before ending this episode?
No, I think the most important thing is just read a bunch. You don't have to be like, you don't have to have a perfect blueprint for what exactly you're going to read. You'll figure out whether or not it's adding value to you as you read it. So it's better to read a bunch and find out something isn't worth it than to be super selective and not go for anything. Annual reports, investor letters, books, all wonderful. I almost forget some of the books I read early on, but I remember getting the most value out of reading the full annual report for a lot of companies. And I'm not talking about just glancing over the numbers. I'm talking about reading through the whole thing, and that includes risk factors and stuff like that. You don't have to read those every time, but once you get an understanding for what risk factors are required, you kind of have, I don't know. If you go through the nitty gritty, you kind of get a good understanding of the accounting for a business, which is really helpful.
And just don't watch any of the scammy YouTube videos that can get you trapped into the date. There's so much of that out there. Just, I know we do post our podcast on YouTube, but there's so much low quality stuff on there that it can get you trapped into thinking things that, yeah, just don't do that. All right, disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in, and we'll see you next time.